Hello and welcome to today's market analysis. Let us start with the key numbers from overnight trading. The Nasdaq closed at 26247, the S&P 500 at 7398, and the Dow Jones at 49609. The VIX Volatility Index held at 17.19, while the 10-year Treasury yield remained steady at 4.36%. The dollar index dropped to 97.84, and the offshore yuan strengthened past 6.80 to 6.7971. In commodities, WTI crude oil settled at $95.42 a barrel, gold stayed elevated at $4,720.40 an ounce, and Bitcoin traded around $80,398. What we're seeing today is a market of stark contrasts. The Nasdaq rallied 1.71% to a new high, but the Dow barely moved, gaining just 0.02%. This tells us that money is heavily concentrated in tech and growth stocks, particularly those tied to artificial intelligence, while most other sectors are not participating. Market breadth is weak, and that is something we need to watch carefully. At the same time, gold is at $4,720 and the VIX remains above 17, indicating that both risk appetite and sentiment are present. The market is in a complex state of mind. Looking at global capital flows, the chain from Asia to Europe to US pre-market trading is still intact. But geopolitical risks and the elevated VIX make this flow fragile. It could reverse at any moment on breaking news. We estimate the probability of a reversal at about 30%. On the macro front, the interest rate environment is neutral. The 10-year yield is stable at 4.36%, and the market has priced in the Fed holding rates steady in the near term. The dollar index falling to 97.84, near a 2-month low, eases capital outflow pressure from non-US markets and boosts the appeal of dollar-denominated assets. But inflation remains a concern. U.S. consumer confidence has fallen for 3 straight months, and WTI crude staying above $95 a barrel is a potential drag on corporate profits and consumer spending. Geopolitical risk is also a factor. The U.S.-Iran conflict is listed by the Fed as one of the top 2 risks to the financial system. The high prices of crude and gold already reflect some risk premium, and any escalation could quickly hurt risk appetite. For core assets, U.S. equities are biased to the upside, but the structure is extremely uneven. The rally is driven by a handful of tech giants, with the Nasdaq hitting a new high at 26247. But the Dow is stagnating. This market is trading on momentum, not value. Support for the Nasdaq is at the 26,000 round number. In China, the CSI 300 showed resilience around 4871. But the Chi-Next fell 0.96%, indicating weak sentiment in growth stocks. The market is waiting for more concrete policy implementation. Bitcoin is steady at 80398, a direct response to the weak dollar and ample liquidity. Smart money is still chasing high beta assets. For commodities, gold and crude have moved beyond basic supply and demand. They now reflect hedging against geopolitical conflict and persistent inflation. There are 2 clear capital flow themes. The first is AI and tech growth stocks. The direction is long, with a probability of 85% and strong continuity. The Nasdaq hitting a record high shows new money is still flowing into AI-centric tech. This is the path of least resistance and the strongest consensus in the market. The second theme is hedging through energy and precious metals. The direction is bullish, with a probability of 65%, but continuity depends on event drivers. 2 high-frequency trading points stand out. First, geopolitical news flow. Any new developments regarding the US and Iran in the Strait of Hormuz will directly trigger instant volatility in crude oil and the VIX, affecting equities, especially tech stocks' risk premium. Second, market breadth indicators. If the advanced decline line continues to worsen while the market rises, it will be a clear signal of deteriorating internal health and could trigger profit taking. We also need to watch the risks. If the 10-year Treasury yield breaks above 4.5%, it would severely impact the high valuations of tech growth stocks. If money flows out of high-flying AI chip stocks but fails to rotate into second-line tech sectors like software and applications, and instead leaves the market entirely, it could lead to a stampede in the entire tech sector. Our strategy for today is to control position size and go long, with a confidence level of 75%. The entry condition is to look for pullbacks within the tech sector and avoid chasing highs. A specific signal would be the QQQ ETF pulling back to its 5-day moving average and finding support. The add condition requires a broad-based rally where the Dow and the Russell 2000 catch up to the Nasdaq, indicating risk appetite is spreading. The reduce condition is if the VIX spikes above 19 during the session, or if WTI crude breaks above $100 due to geopolitical conflict. The stop-loss condition is if the Nasdaq closes below the 26,000 round number, which would signal a breakdown of the short-term uptrend. Let me share our verifiable predictions. First, the Nasdaq will test the 26,300 resistance level within the next 2 trading sessions. Second, the CSI 300 will continue to consolidate below 4,900 next week and struggle to break out. Third, Bitcoin will stay above $79,500 through the weekend close. Fourth, unless there is a clear ceasefire agreement, WTI crude will not fall below $94 a barrel in the next trading session. Fifth, in the next session, the Nasdaq 100 as tracked by QQQ will continue to outperform the Dow Jones Industrial Average tracked by DIA by at least half a percentage point, and the divergence will persist. Our probability assessment for today is 50% for an upside move, 35% for a sideways move, and 15% for a downside move. The market is becoming more divided, with capital highly concentrated. We recommend controlling position size, looking for opportunities in tech pullbacks, and keeping a close eye on geopolitical developments and market breadth. Thank you for watching, and we will see you next time.